Ali from the Blockchain Founders Fund. How are you, sir?
I am fantastic. Thanks so much for having me on the show, David.
Yeah, thanks for hopping on. So, Ali, we haven't had any like venture capital fund type people come on the show before. And I thought this would be a good opportunity to talk a little bit about like the Web3 startup process, maybe even just broadly speaking, the startup world. But before we jump into that, let's kick it off with an introduction on yourself, your background, and how you landed as a VC for a Web3 fund.
Yeah, absolutely. So thanks again for having me on the show. So Aly Madhavji here, managing partner at Blockchain Founders Fund. And we've got now 130 plus Web3 companies that we've backed over the years. And it all started with, just a real passion for this industry, right? So I moved full time into the space in 2016 and, really excited about the future here, really excited about, being able to change the dynamic, even the playing field around the world and, really create access to opportunities for everyone. And after I sold a startup in the space and exited that in 2017, ended up basically starting Blockchain Founders Fund, but less as a VC idea originally, right? So the idea, the thought process originally was like, hey, instead of scaling one startup, let's scale two. And instead of scaling two, it became four. Instead of four, it became eight, where it was a combination, effort and capital. And that actually went really, really well that we raised a new $75 million fund a couple of years ago. And that's sort of what we're working on deploying at the moment and been backing, just really, really incredible companies over the past couple of years through the bear market. And of course, now markets are booming and we're continuing to back just incredible founders and companies that are changing the world and changing the industry.
So I have some questions about how the landscape is like or was like maybe a year or two ago and then how it is right now. But before we get there, what is a VC? How do they operate?
Yeah, absolutely. I mean, at the end of the day, we're looking for essentially founders that we can back, support with not only capital, but our networks, our introductions, our processes. We have a lot of knowledge scaling startups. Most of our team has worked in startups or founded startups and exited startups. And so, being able to bring that expertise to a founder and help supercharge what they're doing, help them sort of grow, scale, help them execute their visions. And then for all of us looking to essentially earn a return off of it, right? So obviously we want to be putting in capital quite early. We want it to be growing. We want the company to do well. And then we want to basically, whether it's 5 years, 10 years, depending, maybe it's sometimes a little less, having essentially an exit opportunity or liquidity then as well for our investors.
So it sounds like that last part, it's not your own money that you're putting forward. You guys are raising funding. You mentioned like raising 75 million and then that goes into like a pool and then you use that pool to deploy capital, right?
Correct. So a chunk of it is our own money, right? So generally when you
Mhm.
raise a fund, you are putting a chunk of your own capital in, and then other investors are essentially coming in as well and backing that vision that we have for supporting founders, growing the ecosystem and backing the best and brightest and helping them supercharge it, really change the way the industry works and really have an impact.
So let's say I'm an entrepreneur. I have this idea for a Web3 game. Let's say it's like a Web3 version of Call of Duty, right? So it's like decentralized. It functionally is like Call of Duty, but you own your own assets. I sound like an American. You own your own guns and bullets and you can sell them and um, armor and all that good stuff. I'm confident this game is going to be a huge hit because everyone loves Call of Duty. For simplicity's sake, let's just say there's no technical barriers involved. Like I can build this game. So I have this idea. Is it a good time to talk to you or is it too soon or what are you looking for?
Yeah, it's a good question. I mean, we do back companies early. I mean, a lot of funds, will wait till sort of like late seed or Series A or Series B or, it depends. We do like backing companies early, and we've actually backed companies as early as literally the day of incorporation, which is as early as you can get, right? And the big things that we want to see though is like, one, do you have a track record experience? And if you are like doing something like this, right? If you don't and you're a first time founder, maybe you're like a new grad, we want to see like very high levels of passion, like, just meticulous on, what you're building, where you're going, and how you're going to get there, right? And we want to be able to buy into that vision of like how you're seeing that, right? That doesn't necessarily mean that you're going to execute everything along that vision in the way that you do, right? So, I mean, a lot of startups pivot, a lot of things change, factors change, markets change, even like you learn things along the way. So we want to actually see coachability as well. So we want to see founders that are going to be dynamic, that are going to learn from their customers, because maybe your customers are going to give you feedback in alpha or in beta saying, hey, like these parts are great, but actually we think this, and this need to change. And if you're listening to your customer, you're going to be able to build a much, much better product, right? And so, we do want to see that. We want to see even them to be coachable by investors in certain respects, but you got to be careful with that, right? I mean, I think many founders on here that are listening will know you talk to 3 investors and you get 3 completely different opinions and 3 different directions. And so you got to be a little bit careful of like which piece of advice you're taking and how you're sort of, processing that and which piece of advice to discard. And I think that's also an important skill. Then we want to see not only the technical aspects of being able to build out what you're doing, but there's always 2 parts, right? Especially on a consumer product. So you need the technical aspects, but then how are you going to market? How are you going to actually monetize this? How are you going to get this in front of people, right? I mean, like, why are people moving from Call of Duty over to this game, and or from the blockchain space? Why are they going to go over to this game? And how are you going to actually get in front of them? Because it's not in, I mean, no industry, but especially this one is easy necessarily to get a lot of eyeballs, right? It can be quite expensive going out and finding your target customer if you're playing that game, right? And so like, what are you going to do to be able to do this like in a very cost effective manner? How are you going to get a lot of people really, really excited about this, right? So those are all sort of different factors that we're thinking about. But generally, when you think about funding stages, that stage, some early VCs make sense. A lot of angels also make sense, right? So if you can get really good signaling, right? Can you find different gaming experts that are angel investors that would invest in this? Can you find, other sorts of like interesting partners? Maybe they're distribution partners and maybe the executives there would, personally back this with 25K, 50K, 100K. And then that starts to add up because you start getting these really interesting, backers that are able to help solve some of these problems early, and like early VCs can help. And then it sort of expands from there, right?
So it sounds like you can have an idea and like a 12 slide, what have you, pitch deck, but you would need a lot of those other criteria that you mentioned. Specifically, I think signals, I would say, right? Like from what I'm gathering, that if you have some angel investors that are kind of already in that domain, that's like a really strong positive signal. If you have like the right partners in place already that kind of already back the idea along the line, also to add on the things that you talked about earlier in terms of like coachability and some of those other soft skill sets. So in that vein, there's always a question of like monetization, right? And so how early as a startup founder should I be having those conversations? Because sometimes there's this like yin and yang relationship, not direct yin yang, but there is a little bit of a yin yang where you're focused on growth versus monetization. So as like a VC at an early stage startup, is the focus more on getting kind of that like hockey stick growth, or is it you want to see monetization kind of like out of the gate? Probably a hybrid of both. How does that look like for you?
I think it depends on the type of company, right? Because if you think about it, right? So, I mean, if you can go get hyper growth without, say, like excessive costs, right? Then it can be really interesting. If you're saying like, hey, we're going to have a $20 CAC, like cost of acquisition, and we need to go get like, I don't know, 1 million users. Well, it's going to be very difficult to go get that without the funding. And to get the funding is probably going to be difficult to get the buy-in, especially, how the market's been over the last year, without like being able to show that the concept works and you can monetize those 1 million users, right? And so like some of it is going to be a chicken and egg. It does depend on the type of business though, right? If you can go hyper scale it or get a ton of users without, say, a high CAC, right? So you can figure out like interesting growth hacking strategies. You can get like, people to really like spread word of mouth, be your sort of champions and, promote it and sort of get this out there. Then like maybe you don't need to monetize right away, because then you can use that to your advantage. And then you can start monetizing once you hit some sort of critical mass that you think makes sense, right? And if you can do that cost effectively, it's interesting. What's really cool about, funds such as ours at Blockchain Founders Fund is we also have about 150 corporate partners. And so we're tier one partners with, providers like Amazon. And so if you're building on AWS and you're going to go try to hyperscale, you're going to end up with all of these costs on Amazon. Well, we can just give you credits that helps you to cover those costs so that you can actually approach that strategy without necessarily a ton of funding. And we have these partnerships with a ton of the different cloud providers, a ton of different analytics providers, payment providers, all those different types of things that startups would use as tools. And this can be a really big advantage because then now you can actually approach that hyperscale sort of strategy without necessarily monetization, without bleeding the costs on all this different sides like servers and processing and payments and all that different stuff where you're going to have a lot of costs. So that's something to keep in mind as well.
Yeah, I think having those partnerships is really paramount as a startup founder, where you don't necessarily have to like shell out the money for. And it might sound nominal, but it can add up real quick to have like a Microsoft Azure account and then like Outlook and then Dynamics and handling like the customer care, like all that stuff can be packaged through a partner, like through the partnerships that folks like you have. So I think that's a huge advantage there. So I know in the VC world, the unfortunate truth is that you invest a lot of money. Some of them work, a lot of them don't work. In your experience, what are some of the patterns that you see where startups fail?
It's a good question. I would say that founders breaking up is still going to be among the most common, right? And that's usually going to be on like a few different parts, which is going to be like misalignments, the grind, some, family commitments. And obviously it's difficult because when you're running a startup, especially quite early, you're not making as much as you probably used to in your, your last position, depending on what you were doing. And so like there are a lot of concessions and there's a lot of things that you got to get around. And, there's going to be plans that you had when you started it that obviously change in a startup, it's sort of like an ever dynamic environment, right? So, that's going to be probably among the most common. I would say that, not being able to really like figure out like that product market fit aspect is also a big factor, right? So sometimes we're backing companies sort of pre that product market fit and really being able to figure out like, hey, would people pay for this? Who are your target customers? How do you get in front of them? Like, how do you get them excited about it? And how do you get them and like build essentially this product with all of that in mind? And that can be a challenge, right? And so you will see a lot of companies just like essentially give up if they don't find that and can't pivot from there or don't want to pivot from there, sort of like, dynamics change. And so, that's going to be another sort of big factor that you're seeing as well.
So oftentimes, and I think like Y Combinator might be one of them, where they're really adamant about having a co-founder or multiple co-founders. When you're evaluating a startup, how much merit and stock do you put in? Like, is that something that is a non-negotiable for you guys, or is there some wiggle room, or what does that look like in your eyes?
So we do back sole founder and co-founder businesses. I will tell you that co-founder businesses are going to have less risk in some way because you do have generally like a very strong technical co-founder, and then you've got a very strong, say, like business sort of co-founder, and that's going to help you to solve a lot of the gaps. Now, it's not necessarily critical, which is why we do have a number of businesses that are single co-founder, but then you also end up with different risks, right? So you get the co-founder side, you have that chance of the co-founders breaking up, right? And then that sort of implodes the business in most cases, right? Especially when it happens early. The sole co-founder, you have the risk of like, well, you've got a single founder that ends up having a lot of control and direction, but that can obviously have its downsides, right? And so I think there's pros and cons to both. And I think it also depends on like what experience levels, what the rest of the team looks like, what have they done sort of historically.
Mm. So you guys invest in early stage, very early stage that you mentioned. That is like the riskiest part to invest in, right? So why have you guys decided to invest in like the riskiest part of the business or riskiest stage of the business?
It's a really good question. I mean, I think there's always sort of that risk reward ratio. And I think there's also a passion side of it, right? So, I mean, personally, like I love working with founders early and helping them solve the biggest challenges. And one of our, objectives when we started Blockchain Founders Fund was that, we want to be the first place that a founder comes when they have a major challenge, right? So, you're having something that might be some sort of crisis internally. And we don't want our founders to think of us as their investors. We want them to think of us as their partners, and like, let's just go roll up our sleeves and figure out how to solve this, right? And so we love doing that. When you think about the returns aspect as well, though, there's obviously the highest returns. If you're coming into a business, at the start, very close to the start, we're obviously getting in at, some of the earliest entry prices on that equity, right? Or tokens, what have you, right? So there is a pro and a con, but you're right? It is going to be a higher risk appetite. It's going to be a higher risk overall to those investments.
And so now we're going to get into the Web3 portion of it. That's where your guys' focus on. You mentioned earlier that there's a passion there, and that's part of the reason for the focus. We obviously had a very bear market. We seem to be kind of getting out of that, but I don't know if we're totally out of, like, it's a little bit of a mixed bag. Yeah, I mean, Bitcoin's gone up quite a bit and it's dropped off a little bit. Ethereum's gone up quite a bit, also fallen a little bit. Some regulatory things going on, but it seems like we're better now than we were before, but clearly we were in a bear market. How did that impact you guys? How were you guys able to weather the storm? Did you guys see some down rounding during that stage? How did you guys navigate those waters? Or how did that terrain look like?
Yeah, it's a good question. I think that the challenge, I would say, or the biggest challenge over the last couple of years before the market sort of picked up, was everyone thinks you're crazy, right? So, your family is like, why are you still in this thing? This thing's over. Your friends are like, hey, isn't that a thing of the past? AI's here. Investors, a lot of even investors are, more focused, more interested in other topics like AI or other things. And, what was really great about that whole scenario, though, was all of the people that were in it for the wrong reasons left. And so, and a lot of investors actually slowed down investing dramatically or stopped investing in the space. And so what that did is it created an opportunity where you could go invest in the best, brightest founders that were super motivated. And you could go invest in these companies when it was a lot less competitive or even non-competitive, let's say, right? Because they wanted capital, they needed capital to go build and scale out these visions. There was a lack of investors and interest in the market. And so we kept deploying through that period and people thought we were crazy. And I think it actually worked out really, really well, because what you saw is these founders that just won't quit, right? So even if they run out of money, they're like, hey, we'll make it work. Like, we'll keep going, we'll keep grinding. And then they raise a couple of checks and, just keep going, right? And that type of attitude, I think, is paying off a lot right now, because now they're years ahead of a lot of the other companies that are coming back to the space now or starting now. And so I think it's a really, really big advantage. And so we're seeing, a lot of companies that did that really capitalize on it in this market right now, which is exciting, as things have picked up dramatically. I do think we're fully out of that bear market. I mean, it's completely changed over the last, 4 months. And we're seeing just a lot of just incredible stuff that was also, hidden under the woodworks. People were just building over the last couple of years that are coming out now that are just, pretty incredible products that are changing the industry. So, we're pretty excited about what we're seeing right now. We've been doing a lot of deals over the last, 6 months. We've probably done close to 60 new deals or so in the last 6 months. So probably among the most active investors at the moment. And
then also, like, as far as like the check size, what kind of checks are you generally writing? Are they like 25,000, 150,000, a million, or what does that look like?
Yeah, so we typically write a minimum of 200K. I mean, there's some cases where it's less, but as a $75 million fund, it gets very difficult to start writing much smaller than that. So yeah, so 75K, and we go up to 5 million per company, but we tend to like to see how things progress and then write sort of larger checks into those companies once we're under the hood and, know the business inside out.
Okay. And so you mentioned earlier, looks like the terrain is a lot better than it was a few months ago. That's really reassuring to hear. What are some of the things that are emerging and interesting that you're seeing in this bull market that we're in?
Yeah, I mean, there's a number of different narratives that I think are quite interesting and exciting, right? So right now, there's a lot of interesting innovation on Bitcoin, right? So you're seeing a lot of interesting like layer twos on Bitcoin. You're seeing a lot of interesting, whether it's people building derivatives or all like stable coins on Bitcoin, like all sorts of pretty interesting things that are happening. We're seeing, real world assets, or how do you solve some of the challenges of decentralized finance or DeFi on chain by bringing yields from traditional markets into on chain markets, right? Because right now, one of the challenges has been, to earn, 5%, 10% in the Web3 world or in the crypto world has substantially higher risk than doing, say, like treasuries or AAA, AA bonds on traditional markets. So I think that's a really exciting opportunity to solve that right now. And we're seeing a lot of interest around that topic. We're seeing a lot of interest around things like liquid staking and restaking. We're seeing interest around, even intents, which are sort of like different financial products, different sort of ways to, I think, make the entire sort of financial aspects of sort of crypto much more effective, right? You're seeing things like liquidation protection. A lot of people that see news on crypto see, hey, people are shorting it or people are long, and you're seeing these like billions of dollars of liquidations on some days. We just invest in a really cool company called Emoja that's doing liquidation protection and solving that problem. And so there's a lot of really, really cool things that are emerging right now in this market that, we're excited about.
I'm going to have to read about that liquidation protection, because I guess that's the thing that keeps me up at night when I'm doing like DeFi stuff. Almost don't want to sleep because I'm afraid I'm going to wake up one morning and, oh shit, like, everything went to zero and I got liquidated or there was some sort of crash. So that actually is a really sharp idea. So I noticed like one common denominator was, I mean, you mentioned Bitcoin, stable coins, RWAs, like real world assets. Are you guys mostly focused on like that, at like the financial, the crypto part of it? Or are you guys looking at other things like, I don't know, maybe PFP projects, maybe tooling and media or decentralized social media platforms? Or are you guys just mostly focused on like kind of the crypto side of things, broadly?
No, I mean, we've got companies in SocialFi, we've got companies on the entertainment side, we've got companies that are using, even enterprise level stuff on the entertainment side. We have a company that's, one of the market leaders right now on actually auditing music streaming and combating streaming fraud, right? And it's stuff that people don't even know blockchain sort of involved in. So there's a lot of really, really cool aspects. I mean, we've got a pretty wide range of things. I mean, we've literally got, if you've got pet owners listening on the line right now, we've got a company that's basically building pet IDs, which is really, really cool. And, and any pet owner is going to know that, for example, when you go to the vet or you like the dog daycare or vet or any of these types of things, you need to bring these vaccine certificates with you, and they're all on paper, right? So we have a company that's basically building pet IDs and digitizing this and solving this problem pretty effectively. And so we got a lot of really, really cool things that are happening, and founders that are building just things that are really changing the industry. We've got stuff in the gaming industry. We've got, interesting layer ones, and we've got really cool things on the tooling side. We've got, a company called Uniblock that's just really, really popular right now. That's basically unified all of the different Web3 APIs. And so you can just click one button as a developer to turn on any API instead of having to spend a year building out 50 different APIs or 100 different APIs. You now can just, integrate one and click one button to turn on any of the other ones, right? So cool things like this that just make it even easier for developers to build in the space and make it more effective. So a lot of really, really cool innovations coming.
Gosh, I wish I had that 12-page deck earlier, because that's something that's always thought about. That's something I've always thought about too, just having this like unified API as opposed to all these like different silos. And yeah, all right. So I missed the boat on that. Someone else is already working on it. Very, very cool. And also along the lines of pet ID and health records, both Carrie, our show producer, and myself were both pet owners. And that's something I not as a business idea, just kind of like thinking out loud. And I think more broadly, even speaking about human healthcare, is like having it more decentralized, because it's like you go to a doctor, they own the records. It's a pain in the butt to get like from one, at least here in the US, from like one doctor to another. Sometimes they don't want to share it. Sometimes they want to share parts of it. And at the end of the day, it's like, these are my records, not your records. Like I should have ownership of it. And I think that is something that is very much relevant and applicable to, I mean, there's so many different things. That's why we have this podcast. There's just so many different valid use cases for the blockchain.
Yeah. So just quickly on that one, when you think about health records for humans versus say health records for pets, with pets, it's a lot easier to execute because of
Oh yeah.
compliance, right? So
Hmm.
they're actually kind of the same problem, but one has a huge compliance cost. You got to keep data within a certain state or like region or things like this, or within a specific country. You got like HIPAA compliance, things like this. So it's a lot more complicated when you're doing it with human health records versus pets. And that's where, we're really excited about being able to do it on the pet front. On the human front, we haven't seen a ton of things that we think make a lot of sense, just because a lot of the regulatory barriers, a lot of the cost dealing with that. I think it becomes a lot more challenging trying to do it on the human.
Yeah, absolutely. A lot of red tape I could see there. There is this meta that gaming is going to be like a big thing in Web3 like this cycle. I'm not a big gamer myself, but I certainly see like there being a use case for that and a lot of applicabilities. Kind of similar thing. I mean, when we're talking about blockchain, like just having like the ownership of the assets as opposed to, I don't know, what's the name of the company that owns Unisoft or whatever. I can't remember the name that or Activision or what have you. Like they own the assets, EA Sports. So all that's to say is, and I know that you're at a gaming conference right now, so I think the answer to this is yes. But I'm assuming that you see or you're expecting like a lot to happen on the gaming front. Are there some trends that you are starting to see surface up from there, aside from the ones that I just talked about, which is kind of the obvious, which is like owning the assets as opposed to the entity administering the assets owning them?
Yeah, I think there's a lot of opportunity here, right? But I think it's still a very challenged market. So we started investing in blockchain gaming at the start of 2018. And at the time, nobody in the world basically had a thesis on blockchain gaming. I think now it's changed a lot, but I think it also has struggled to overcome certain challenges. So the biggest problem that we saw sort of in the last bull cycle, right, was you had these companies, whether it's Axie or many others, and as soon as like the industry got a little bit popular, the game got a little bit popular, these asset prices skyrocketed, right? So imagine, I don't know, imagine you have swords in a game and there's 100 people that join and it's $1 each for the sword. But then the next 1,000 people that join, there's still only 100 swords. And so now they're $10 each as an example, because those people are willing to sell it for 10. Then the next 10,000 people join and now these swords are $100. And like that becomes its own barrier to just new entrants, right? And so this is actually a huge issue. And the game can't launch new swords because like they're NFTs. And if you do that, your biggest players, which own the swords, are going to be really pissed off. So you don't want to piss off your biggest customer or customers. And so this becomes, I think, a huge issue in the Web3 space. And it's still, I would say, like vastly unsolved from the last bull market. And so we actually do think that the best solution is rental markets for NFTs, but not necessarily even fee-based rentals. So it's not, hey, I'll rent you this now for $1 a day. It's, hey, I'll rent you this, but it's all smart contract based. I'll just take 30% or 10% or 50% of what you make. But like, it's just all automated rentals, and like, it's a marketplace, and you can even rent like a whole collection of equipment for starter packs or for silver level or bronze level or whatever, right? And I think that actually makes it a lot more effective. So this is something that we're quite interested in. We invest in a company called Nifty Arcade that's doing this, but we think that this problem really needs to be solved for this industry to take off. Otherwise, if we don't solve this, I'm not saying that gaming is not going to be popular in this cycle, but what's going to happen is you're going to end up with that really big bust cycle, right? So you're going to have all of that hype. The same thing's going to happen. You're going to have a lot of people get really hurt again because there isn't really a solution around how new players can keep coming into the game. And so it's just going to, really stagnate. So that is a problem that we're looking at. There is a lot of really cool things happening in gaming. So take the intersection of gaming and AI as an example. There's a really cool sort of conglomerate of gaming called Futureverse that's just really pushing the boundaries on how gaming can sort of evolve. They launched the first AI football league with FIFA through Altered State Machine, and a number of other really, really cool things that I think are really changing the industry. And then we also see, not only AAA gaming being interesting, but even things like hyper casual gaming, right? And if you take, for example, one of the companies we invested in called Breshna, what they do is they allow anyone in the world to create a video game in under 10 minutes with no code, right? So hyper casual games, now they even just launched the world's first text to game engine. So you can just say what you want or type what you want and it'll build you that game in a minute. So you could say, hey, like create me a Wordle game that's around, Mario and unicorns, and like you'll have a game that gets built, right? Or, build me, a Flappy Bird type game, but with tanks and and horses, and it'll build you that, right? Like all sorts of just really cool things. And so they've had over 150,000 games built in the last, number of months, and, a lot of really, really cool things happening on that front as well. And so I think also the boundaries of how we think about some of this stuff is going to change pretty dramatically over the next few years.
So for what you described earlier with those games that are being generated like that, are those games intended for like a mass audience or for just the audience of the person that created them?
Yeah, so it's interesting, right? I mean, if you think about hyper casual, I mean, it still makes up a very large segment of revenues of the total industry. I mean, a lot of people think about, those AAA games, but if you think about like, hey, you're on the train, you're going to be playing games like Candy Crush or Wordle or like different things like that, or if you're in the bathroom or whatever, right? I mean, you see people play games in all sorts of different environments, right? And so what we're thinking about that is, I mean, sure, there's definitely the aspect of like you and your friends and playing it in that sort of aspect. But what we're seeing now is like teachers are making it and sharing it, and it's sort of going viral between like different age ranges, and then they can also monetize that. What we're seeing is like, maybe even like a fraction of those games, it doesn't even need to be 1%, are actually going to be popular based on a specific topic, and those can go viral. And so it's a very different way of thinking about gaming that, hey, every game needs to be a hit. If you make 1 million games or 1 billion games, you don't need even 1% necessarily to be, say, a massive sort of mass market appeal or very large niche appeal, right?
Do you see a scenario where someone's making a game like that and they're taking that to like the market, monetizing it, maybe getting like VCs involved to help scale it?
I mean, if you're taking like an individual sort of hyper casual game, I mean, there's definitely a bunch of big hyper casual games, right? I mean, take like Candy Crush, Wordle, like there is massive games like that. So, I mean, you definitely could. Generally, you do see those types of, games turn into, say, game studios then, and they end up launching multiple games or multiple hyper casual games. Freshness came in a very different way because it's, how do we essentially create the Canva for video games and launch millions of games or billions of games, right? So it's even sort of taking that, put it on steroids.
So something that's adjacent, I think, to games is this concept of owning land, like Sandbox, for example, Decentraland. What's your guys' thesis on that? I mean, not specific to those companies that I just listed, but this whole concept of like a metaverse, land ownership. Is that something that you guys are investing in? Is that something that you guys have some criticism or skepticism, I should say, around?
Yeah, it's interesting, right? I mean, we are major landholders in several different ecosystems. Having said that, we do think that the metaverse itself and that whole concept has struggled, right? One of the big things that sort of required, I think, around any of these products, games, metaverses, whatever you want to call them, they sort of have different shapes and sizes, is there needs to be some sort of like economic model or economic ties to it and how that sort of benefits from that supply demand within the game. So it needs to be like integrated quite well into that. And I think that is still a struggle in certain respects for some of these different ecosystems. But we do still see definitely a future on some of these types of assets as long as it sort of makes sense in that economic model.
So last question here is around gaming still, because I think that's something that a lot of people have been talking about lately and is topical. So you've got like PFP projects and you've got some of them trying to incorporate themselves in some of these like land-based games. Do you see there being like product market fit? Do you think that the average like PFP holder does expect to be able to have their PFP in a metaverse, or do you think that they have different expectations from being a holder of a collection that might be more like utility based around other things? Or what are your kind of thoughts around that?
Yeah, I would say when you take like PFP projects, I mean, we're seeing like a couple of different things, right? So you're seeing some that are like sort of these one-offs and like founders are maybe doing multiple things or go to other things pretty quickly. And those I think are going to be more difficult because like there's not a lot of attention on them or focus on them sort of long term, right? And like building a lot of those ties, building a lot of that utility. When you think about the point of some of these PFP projects, it's also about like an identity, a community, all of those different aspects that are part of it. And so that's essentially part of what's creating the value around. I do think that increasing utility is important because if you think about like the identity and community, a big part of that's going to be like the visibility of that and like people being aware of that and understanding what that is and, wanting to be part of that community because that's also going to increase the value of the entire sort of PFP collection as a whole. So that's where they're going with it. I mean, you're seeing everything from digital aspects that some of them are doing to physical, right? And events and all sorts of stuff. Whether that's like access to VIP clubs, different things. You're seeing all sorts of different things happening with them. I think some of them are going to continue to retain value and grow because they're basically communities and people want to be part of those communities if those communities can create value for you, right? In terms of like life value, identity, like those factors. But a lot of them are probably going to cease to exist because like if the founders aren't focused on it and they don't want to grow it, well, then like the value of that community and that identity is probably declining. So long term, there's probably challenges around.
Yeah, totally agree. So to round things off, going back to my idea earlier, not Command and Conquer. I'm dating myself here. Call of Duty. All right. I really want to pitch this idea to you guys. Do I reach out to you guys directly? Do I need to like get a warm introduction from one of your portfolio companies? What does that look like? Because I know different funds operate differently.
Yeah. So what's really cool about us is, you can reach out to me, any of our partners, any of our team, and just share what you're working on. And actually, what's interesting is we actually look at every single one. So, a lot of funds, might not be doing that. They might only be looking at sort of warm introductions. Like we don't need that. Having said that, we will want to know, how you're going to sort of really execute on this vision. We're going to want to know your background. We do reference calls, so we will end up talking to people that, are knowledgeable, but we don't need them directly from our network because at the end of the day, I mean, we don't know everyone in the world and, and there's going to be incredible builders in different parts of the ecosystem that, we might not know off the top, right? We'll be able to figure out, some ties and some links later on as we get through our process. But that's an important part about this industry when you're thinking about a fully global industry, right? Like that strategy works for a fund when you're investing in, startups out of San Francisco. But if you're going to say, hey, I'm investing in startups out of San Francisco and London and Dubai and New York and Singapore and Hong Kong and, maybe even Latin America and Africa and Australia and Europe, I mean, you can't just follow that strategy. I think it can be short-sighted.
That's really awesome to hear because our listeners might not be aware, but I would say more often than not for VCs, they would, even though they might not say it outwardly, they would want some sort of like warm introduction. And it's not very common for them to just be able to reach out to directly to them. It happens sometimes, but it's not super common. And it's awesome to hear that you guys have that perspective on it, that you guys are building something or you guys are part of something global and you want to support a global network. And so you don't know everybody, and there could be some diamonds in the rough there by just limiting it to within your network. So very cool. So I'll leave your guys' links in the show notes. So if we have any prospective founders or maybe existing founders that want to connect with you guys, they can. Aly, I really appreciate you taking the time out today and speaking to myself and just kind of driving awareness for our listeners around what the VC landscape, what the startup landscape is like in Web3. Looks like it's pretty promising. So although we always say that like the bear's a good time to build, but it seems like the bull is equally as good too. So I think we've got good times ahead.
Absolutely. Thanks so much again for having me on the show.